insurance company and a company that deals with long life assets. I've never heard of those before, but we're going to hear about them now with Todd Bunton, who is our growth and income stock strategist here at Zacks. And just because it sounds interesting, let's take the long life assets company first, Brookfield Infrastructure Partners. This is a limited partnership?
It is. It's not a master limited partnership. It is a little different from an MLP. But yeah, it's a limited partnership actually formed in early 2008 by Brookfield Asset Management. They're still the general partner here, and they own a good chunk of it.
So what are long life assets?
It's things like utilities. They have a big utility operation. They have transportation and energy operations. They also own some timberland. So stuff that they want to generate stable, strong, long-term cash flows with minimal capital expenditures, and stuff in high barrier to entry places. And they've done that. They have a very stable business model here, very strong cash flows. That's why it's a good income pick as well, which I'll talk about in a second. But the company's delivered 8 consecutive positive earnings surprises. So they have very good earnings momentum here. They just came off a very solid quarter. Beat the Zacks consensus estimate by 7 cents. They saw a 20% increase in their funds from operation, which is essentially earnings per share plus depreciation, because of those long life assets, they depreciate them. So that's a depreciation expense, but it's not really a cash expenditure. So if you add that back in, you get funds from operation to give you a truer picture of earnings, at least now.
And these are assets that appreciate in value over time.
Exactly, and that's the key, is that they can increase they can increase prices with inflation, and they generally grow with gross domestic product. They have operations all around the globe too, so it's not just concentrated in North America. And that, like I said, has generated strong, stable free cash flows for them, 8 consecutive positive earnings surprise, and they've seen a strong increase in estimates from analysts lately after the strong beat. It's a Zacks rank of 1, which is a strong buy rating, and analysts expect solid, stable growth to continue over the next several years. And like we've been talking about, is that stable business model, you get strong free cash flows, and they've been returning that to shareholders through higher distributions. It's technically a distribution, not a dividend, because it is a limited partnership, but that's just semantics. But if you take a look, since they were formed in 2008, they've increased their distribution at a compound annual rate of 14%. They pay dividend distribution that yields 4.3%, very solid, and they just announced a 15% increase in that distribution. So a lot going right for this company. If you look, they traded about 13 times forward earnings. That's in line with its historical median. So there's strong total return potential here. Like I said, they have the strong earnings momentum, so it's a good play over the next 3 months. And because of that stable business model with strong free cash flows, it's a good long-term pick too.
Long life assets. Amazing what you learn here, isn't it? Well, here's a company that I'm a little more familiar with, Arthur Gallagher.
Yeah, they're an insurance brokerage and risk management firm. Insurance brokerage is the lion's share of their business. They were founded in 1927, so very old company. They've been publicly traded since 1984, which you don't see a lot of insurance brokerages publicly traded, but this company's been around. They're growing. They're constantly acquiring. They have operations in 18 countries. Market cap of $4.9 billion, so it's not your little ma and pa insurance brokerage.
No, not at all.
And they delivered a strong fourth quarter earnings beat. Earnings per share beat by one penny. Revenues were up solid year over year. They saw a strong increase in brokerage revenue, strong organic growth too. Like I said, they've been acquiring, so they saw about an 18% increase overall in brokerage revenues, but about a 5% increase in organic revenues too. And the risk management side of the business performed well too. So a lot going right for these guys. If you take a look, following the last earnings beat, you can see analysts have almost unanimously raised their estimates for 2013 and 14. And that's the slide I brought with me here. The 2 biggest factors of the Zacks rank are the agreement and magnitude of analyst estimates. And you can see, like I said, almost unanimous increases in estimates and a decent bump in both 2013 and 2014 consensus estimates. Drove it to a Zacks rank of 2, which is a buy rating. So good earnings momentum here. And if you look at consensus estimates, based on that, analysts expect 26% earnings per share growth this year, 13% growth next year. So good growth story here and a good income story. They pay a dividend that yields 3.7%, very solid yield. And going back the last 10 years, they've increased that at a 7% compound annual rate.
Wow.
So good income to go along with that growth, and all that at a fair price. They trade about 3 times book value, which is in line with their historical multiple. Could be another good short-term play and long-term play as well.
Okay, do you own either one?
I do not.
All right. Check out other stock picks and stock picking strategies. I like saying that. On our website, Zacks.com. If you're not there already watching this video, you can link to them right off the homepage. With Todd, I'm Terry Ruffalo.